Benjamin Graham, How to Invest for Beginners. Welcome back to Wealth-ology. For today's video, we will be going to talk about How to Invest for Beginners by Benjamin Graham. Let's get started. A high IQ, insider information, or even luck are not required for successful investing. Instead, a strong logical foundation for making decisions is essential, as well as the ability to keep emotions at bay. In The Intelligent Investor, Benjamin Graham offers a framework that combines reasoning and emotion to help you keep your emotions in check. He has perhaps had one of the most successful investment strategies in the last 100 years. It's difficult to miss Graham's and many of his students' stellar records. Warren Buffett, the world's third wealthiest man at the time of filming, is the brightest blazing light among them. This book is by far the best book on investing ever published, according to Warren Buffett. We'll show you the most important lessons from the book in this video. Takeaway number 1. Meet Mr. Market. Consider owning a $1,000 corporation share. Mr. Market, a bipolar man, comes to your house every day with an opinion on the value of your share of the company. On that basis, he also offers to buy or sell you an additional stake. Mr. Market's estimate of how much your share of the business is worth has shown to be utter nonsense in the past. For example, he projected the value of your stock at $2,600 in March 2000s. He thought it was worth $500 only a year later, in March 2001, despite the fact that the company's revenue climbed by 50% and profit increased by 20% during the same period. Should you allow this man to determine the value of your $1,000 investment in that company? Certainly not. One of Graham's basic beliefs is that a stock is more than a ticker symbol and a price tag. It is an ownership stake in a company. Because Mr. Market isn't always reasonable, the business's fundamental value may differ from the price he is ready to pay for it. In fact, it is usually over or underpriced, since Mr. Market is prone to becoming either optimistic or pessimistic. Graham advises you to invest only if you would feel comfortable to hold the stock in the future without seeing the fluctuating prices that Mr. Market presents you with. But for the investor who can keep his head still, it's a different story. Mr. Market offers a terrific opportunity to make money because he doesn't compel you to do business with him. Rather, he gives you the option to do so. You should be pleased to sell to him when he offers absurdly high prices, and similarly, you should be happy to buy for him when he offers you great deals. It's important to remember that when Graham wrote this book, people weren't as bombarded with the news, predictions, stock prices, and other data as we are now. In the 1970s, Mr. Market would visit once a day with the morning newspaper. He wants to do business with us every time we pick up the phone today. This happens at least 100 times a day. If you're anything like me, Mr. Market may pay you more visits. But that doesn't mean you have to deal with him any more than people did in the 1970s. Ignore him if he doesn't make you an offer that meets your requirements, and go about your business. Takeaway number 2. How to invest as a defensive investor. According to Graham, there are two categories of investors: defensive or passive, and entrepreneurial or active one. The majority of people are better suited to the defensive strategy because they have little time to invest. The defensive investor should build a portfolio that includes a mix of bonds and equities, such as 50% stocks and 50% bonds. It's important to remember how much you should put into each asset category is determined by your personal circumstances and the present difference in the average average yields of stocks and bonds. Once or twice a year, restore these allocations. So, if stocks suddenly make up 60% of your portfolio and bonds make up 40%, sell stocks and buy bonds until 50-50 ratio is restored. Regularly, invest a certain amount of money. For instance, soon after you get your paycheck, dollar cost averaging ensures that stock and bonds prices are fairly average in this way. Most importantly, it will ensure that you do not make purchases at the wrong season. The defensive investor should aim for the following 8 for the equity component of their portfolio. 1. Diversification of the businesses in which he invests. 10 to 30 businesses should suffice. Also, make sure you're not overly focused on one industry. 2. The businesses should be large, as described by Graham as having annual sales of more than $100 million. In today's money, this would be worth around $700 million after inflation. 3. Look for companies that are conservatively financed, such as company has a so-called current ratio of at least 200%. This means that its current assets are at least twice as big as its current liabilities. 4. Dividend should have been paid to shareholders for at least the last 20 years. 5. No earning deficits in the last 10 years. 6. Earnings have increased by at least 33% in the last 10 years. This amounts to a cautious yearly growth rate of 2.9%. 7. Don't pay too much for assets. The stock should not be sold for more than 1.5 times its net assets value. Subtracting the company's liabilities from its assets yield the net asset value. 8. Don't spend too much for your wages either. When utilizing the previous 12-month earning, the PE ratio should not exceed 15. Investing in an index fund, which will have returns that are similar to the market average, is an option today. If you're happy with an average return on your assets, these 2 preliminary conclusions will suffice. You'll have to think about it if you want something more. Takeaway number 3. How to invest as an enterprising investor. Beating the market looks to be a simple endeavor because calculating the market's average return is so simple for the defensive investor. You just put it in a little more effort than these average investors, right? Becoming a wise investor and outperforming the market is significantly more difficult than such logic implies. Patience, discipline, a willingness to learn, and a large amount of time are all necessary. Even professionals and private investors may not be interested. Mr. Market's price quotations are much easier to fall victim to than one may think. Listen to these 2 statements made by the head investment strategies of 2 prominent mutual funds in the early 2000s at the height of the dot-com bubble. It's a new world order. We see people discarding all the right companies, with all the right people, with the right visions, simply because their stock price is too high. That is the worst mistake an investor can make. Is the stock market riskier today than it was 2 years ago, simply because the prices are higher? The answer is no. Both assertions, of course, proved costly to the investors who put their money into these funds. Because a company's revenues are finite, the price a prudent investor should be willing to pay for it is also limited. Price is a significant issue for the entrepreneur investor. Similarly to how the market tends to overvalue companies that have experienced rapid growth or unglamorous, the market tends to undervalue companies that have experienced poor growth. As a result, a prudent investor should avoid so-called growth stocks as much as possible. Why? Because the investment decisions is based on future earnings rather than present prices. Future earnings are less predictable. If you can identify a company that is worth less than its net working capital, you effectively pay nothing for all of the fixed assets, such as buildings, machinery, goodwill, and so on. Total liabilities are subtracted from current assets to arrive at net working capital. During Graham's financial career, such businesses proved to be extremely profitable. Unfortunately, they are uncommon nowadays, particularly in times of severe bear markets. Fortunately, Graham proposes another way for the ambitious investor to locate investments. These criteria are similar to those used by defensive investors, but the parameters are less stringent, allowing the entrepreneurial investor to analyze a broader selection of businesses. There are no limitations on the size of a company. Diversification is likewise advised, albeit the number of companies held by an active investor isn't fixed. When examining a company, a wise investor should look at its yearly financial reports. Graham has produced a book called The Interpretation of Financial Statements about this topic, so we should talk about it more at a later time. Takeaway number 4. Insist on a margin of safety. The risk of being wrong is one of that no amount of thought can ever eliminate. This risk, however, can be mitigated. To do so, every investment you make must include a margin of safety. As previously said, the price and worth of a corporation are not necessarily the same. When the price is at most 2/3 of its assessed worth, the investor has chosen a company with an appropriate margin of safety. You shouldn't build a ship that would drown if 31 Vikings boarded it if you knew it would be used to transport 30 of them on a daily basis. You shouldn't invest in a stock that you believe is worth $31 but is now valued at $30. It's possible that your calculations are incorrect. In the first situation, you might be pursued by a horde of enraged and wet Vikings. In the second, you could put off achieving financial independence for a few years. Use safety margins. A method in the book can help you figure out how much a firm is worth, and as a result, if it can be bought with a margin of safety, current average earnings times 8.5 plus 2 times yearly growth rate predicted the growth rate should be equal to the expected yearly growth rate of earnings for the next 7 to 10 years. In September 2018, the 3 largest companies in the S&P 500 were appraised using the technique. It's worth mentioning that we can use the same method to figure out how much these companies must grow in the next 7 to 10 years for today's stocks prices to be reasonable. There is a huge discrepancy here. According to its stock price, Amazon is forecast to grow at a 74% annual pace, whereas Apple is expected to grow at only 5.8%. Do you believe this is reasonable? Takeaway number 5. Risk and reward are not always correlated. According to academic theory, an investor's projected rate of return must be proportional to his tolerance for risk. The risk is then calculated using the volatility of the investment return. In other words, how much has it deviated from its expected value in the past? Graham disagrees with this assertion. Instead, he contends that asset prices and values are frequently divorced. As a result, an investor's expected return is a function of how much time and effort he devotes devotes to locating discount assets. The conservative or passive investors gets the lowest return, whereas the entrepreneurial investor with the most intelligent and skill gets the most. Consider the following scenario. It's 4 a.m. You've been out drinking with your friends in the streets of Moscow since the morning. You decide that it's too early to call it a night, and therefore, you end up in the more obscure parts of town. Do you want to play a game? A man asked you in a particularly unclear bar. Well, of course, games are fun. Your bravest, least sober friend responds. A revolver with a single bullet is placed in front of you by the man. If you dare to take a shot, Russian roulette, I'll give you $10,000. Your drunk pal lunges for the gun, but you stop him. I think we'll pass on this one. You inform the man respectfully. I thought so. He responds, how about $100,000 for taking 2 shots? This story now reflects the academic manner of requesting a greater possible benefit for taking a greater risk. You were offered $10,000 with a 16.7% chance of blowing your brains out in the first offer. Because the chance of creating a hole in your brain has grown to 33.3%. The payoff in the second offer is $100,000. Isn't that reasonable? But investing in the stock market doesn't have to be that way. Keep in mind that price and value are not synonymous. You have a high potential profit and a low risk when you buy a firm for 60 cents on the dollar. Furthermore, if you can find another company for 40 cents on the dollar, you've discovered a higher potential payoff, combined with even lower risk. How could anyone in their right mind claim that buying a dollar for 40 cents is riskier than buying a dollar for 60 cents just because the possible payoff is higher? A quick reminder of the 5 key takeaways. First, the market can be both overly optimistic and gloomy at times. Allowing this to alter your impression of your assets' true value is not a good idea. Consider working with someone who has no idea what he's doing as a business opportunity. Second, the defensive investor should choose a diversified stock and bond portfolio, with low-cost problems dominating the equity category. Finally, the astute investor should seek out stocks that have lower price trends. He might have found his El Dorado if he can find a company that is trading below its net working capital. The fourth conclusion is that when purchasing an asset, a wise investor should invest on a margin of safety. Finally, takeaway number 5 is that risk and profit aren't always linked. What are your thoughts on Graham's suggestions? Are they just as relevant today as they were in 1970s? So, which of the Benjamin Graham's takeaways have you found to be particularly useful for beginning investors? Please let me know in the comment section below. And if you like this video, please give it a thumbs up, turn on the notification bell, and subscribe to our channel for more. Thank you for taking the time to watch. Stay tuned for our next video.